Hello everyone, my name is Paulina and welcome to my YouTube channel. Today I will introduce what I believe the most important and the most foundational concepts of the entire finance and investing series. If you do not understand the concept of time value of money, you pretty much cannot move forward with any of the corporate finance valuations or investing topics. So let's get started. Let me give you a quick example. Imagine that you did some work. Well, let's say you mowed the lawn for your neighbor for months and now it's time to get paid. Well, your neighbor comes to you and tells you, I can either give you $100 today or I can pay you that $100 a year from today. Which one do you choose? If I ask this question in a classroom, usually most of my students say, well, yeah, I'll choose $100 today, of course. And it seems like a pretty rational decision to make. Why do you choose $100 today, though? Let's think about it. What could be the reasons behind it? Well, first reason is because you could take those $100 and go buy something and start enjoying your purchase right away instead of waiting for the entire years to get paid and making a purchase back then. The second reason might be you might decide to save that money and put it in your savings account and earn certain rate of return on your money. And at the end of the year, you might have more than $100 on your bank account. That's a pretty good reason as well. The third reason might be is that a year from now, you run into risk that your neighbor forgets that he's supposed to pay you $100 and you would have a hard time or some sort of uneasiness reminding him. Or in a worst case scenario, the neighbor might forget and move away into a different neighborhood and you would have no way of finding him. So you actually run into risk of not getting paid at all 1 year from today. Well, let's change the example a little bit. Let's say the neighbor comes to you and tells you, I will give you $100 today or $105 a year from today. What do you choose now? Some people would choose $100 today, some people would choose $105 of today. What will determine that choice? What is the value of going through all that trouble of not being able to make a purchase today or not being able to save for a year or running into risk of not getting paid? How much does all this trouble worth to you in a dollar amount? Is $5 enough of the compensation or not? That's something for you to decide to put the dollar amount, but what I will show you today is how to calculate that dollar amount. Let's introduce the timeline. In our example, we only have 1 year, but let's say we can have 2, 3, 4, 5, 5-year time horizon here. So we have a choice of getting $100 right now or a certain amount at the end of the year 5. Let's say the neighbor extended the payment period and now he wants to pay us 5 years from now. So how much money should he pay us 5 years from now in order for us to be indifferent between getting paid today or 5 years from today? Something that will help us calculate the dollar amount is the concept of interest rate. Either we can call it interest rate, discount rate, required rate of return. Those are almost interchangeable terms and we will use those terms when we do different types of problems. But in this example, you can think of all those terms as being the same. So let's say our required rate of return, or you can call it as, you can think of it as required rate of compensation for taking all the risk associated with getting paid 5 years from today and going through all the trouble associated with us getting paid 5 years from today versus getting paid right now is 10% a year. Where did I get this 10%? Why is it 10 and not 7? This is very arbitrary. I put 10% in order to make our calculations easier. But in the future videos, I will show you different methods and different concepts of how you can actually come up with this 10%. I will make a note though, even though we will have a lot of formulas, they will give us some guidance of the way we can calculate the percentage rate here. At the end of the day, it's extremely difficult to come up with the exact number. And in some point, you can use all the formulas, but at some point you have to use your subjective judgment. And this is very hard, and it might be one of the hardest things you will have to do in the entire career of investing. And there is certain art to it, more than a science, even though there will be a lot of quantitative and sort of scientific tools that will help you to determine that rate. But for now, let's pick 10% and let's see how we can calculate the dollar amount we need at the end of the year 5 versus $100 today. And we will introduce the formula of calculating the future value. And the formula goes just like this: $100 times 1 plus our discount rate raised to the power of the number of years or periods that we have, which is 5. And in this example, it's $161. So in order for us to be indifferent between receiving money today and 5 years from now, the neighbor should offer us $161 a year 5 years from today. And then we would pretty much not going to be able to decide. But if you offer us $170 5 years from today and we only require $161, we would probably pick $170 5 years from today. So let's so here we used 5 years. Imagine the example. Let's say instead of having 10% and we compounded every year, so we had 10% year 1, 10% year 2, year 3, 10%, 10%. Let's say instead we have 5%, but we multiplied every 6 months instead. So we have instead 10 kind of smaller periods. Would it be $161 at the end as well? And the answer is no. Let's calculate it. So we have $100 in the beginning times 1 plus 0.05, which is our discount rate. How many periods we have now? Instead of 5, we have 10. And what is the answer? It's $162. I calculated everything prior to the video, but feel free to double check me on your calculator. So this is the effect of compounding. If we compound our rate more frequently, then the end result is the higher number. And this is very important concept to understand. Also, if we compound something at the higher rate, our end result will be a higher number. So if we were to graph it, let's say we have $100 today, and this is our years, and we compound it at 10%, we will end up here. If we compound it at 15%, we will end up here. And if we compound it at 5%, we will end up somewhere here. Similarly, if we compound something at the higher frequency, our $100, let's say this is our yearly compounding. If we compound something at every 6 months, we will end up with a higher number. Versus if we compound something every quarter, we will end up with even higher number. So this is a very important concept to understand as well. So let's talk really quickly the other way around. Let's pick an example. Let's say we are looking to make a purchase in 5 years, some large purchase. Let's say we want to buy a motorcycle, and the motorcycle costs $10,000. The question is, how much money should you put on your bank account today in order to have $10,000 5 years from today? And let's say on your bank account, on your savings account, you can earn 10% yearly in compounded interest rate. Just on a side note, right now in the year 2015, you will not be able to earn 10% on your savings account, but there have been periods of time in history where you could, and there might be some periods in the future where we would be able to earn 10% on our savings accounts. So the compounding of the rate going to the future period is called future value, and I abbreviate it as FV. Going the other way around, discounting something from the future to present, called present value, and I abbreviate it as PV. What is our formula for the present value? It's goes like this. We have $10,000, and now we divide it by 1 plus our interest rate to the power of the number of periods, and the answer is $6,209, and that is the amount we need to put in a bank account today, or 10% yearly rate, and then we will end up with the $10,000 at the end of the year 5. A quick note, as you noticed, actually 1 plus rate to the power of 5, and we have 1 plus rate to the power of 5. This is called discounted factor. In some textbooks, you might be able to find a table of discounted factors, and it's really easy to use that table. You just look up the rate on one side and the periods on the other side, and you find this whole number, pretty much 1 plus rate to the power of number of periods, already calculated for you. It's also very easy to calculate present value and future value in Excel or on a financial calculator, and I might put up some videos in the future, kind of tutorial on showing you how to do that. So this is it for today. We went through 2 very simple examples of calculating and understanding the concept of future value and a present value. In the subsequent videos, we will add some more difficulty. For example, in our saving for motorcycle example, maybe you do not have $6,000 to put up today, but you can make payments every year, or let's say even every month. So what payments, what is the amount of payments you need to put in your bank account once a month in order to end up with $10,000? So we will solve problems like that and introduce a little bit more complex formulas in the future videos. And as usual, if you have any questions, please respond to this video. Just put your question in the comments, and I will do my best to answer all your questions, or send me a message if it's something more involved. And also, if you would like me to put up a video on a certain topic, again, send me a message and I will be happy to try to do that. Thank you very much. Hope you found it helpful, and we'll see you next time. Bye bye.